Welcome back to the Hurdle Rate for the week of October 13th, 2025. I'm Tim Kotzman. I'm here with Jeff Walton, Ben Workman, Matt Cole. Episode 31. I was just telling Colin, we're almost a third of the way to 10% of the way to 1,000 episodes. So it's pretty exciting. Exciting times. He said he appreciates my forward thinking. Lots of stuff going on, especially Friday to Sunday. As most people know, a record liquidation. We had a strategy buy this morning. I was up in New Hampshire this weekend at an event, and Mark Moss joined us remotely, and he told a story about meeting with Saylor in DC, and Saylor basically said to him, you need two things. You need a common stock ATM, and you need an STRC strike type instrument for success. So intrigued to see if you guys have any thoughts on that. And Matt, you posted over the weekend that you are feeling the most bullish you felt in a few years. So intrigued to hear more on that. And of course, today Strategy has posted a video highlighting that STRC is currently offers a 10.25% annual dividend rate paid monthly. So there we go, right? Interested if there's any thoughts on that. Jeff, you had a note in the show notes, our internal show notes about the private credit market. So maybe we'll dive into that. And right before we started recording, Ben, you reposted a post about the October 11th crypto crash, what really happened, and whether we want to get into it or not. It kind of goes through a Binance pricing flaw that was exploited. So I thought that was an interesting read. Appreciate, Jeff, you sharing that. That's all I got. That's the intro.
That was it, huh? Nothing's happened out
Nothing's
there?
happened.
Quiet weekend.
Boring week.
Yeah. No, slow news day. It's just Josh getting blocked by Saylor. We got nothing else.
Yeah, it's been wild this weekend. I mean, the crash was pretty impressive when you see those cascading liquidations, and a lot of us were on a call while it was happening live, and you're starting to see the weakness hit the market, and you see Bitcoin draw down, and it doesn't really hit you as any big deal because, that happens a lot in Bitcoin, right? We've seen lots of these liquidation events, but then all of a sudden you start to see the book get really thin. And all of a sudden Bitcoin's jumping around by the thousands of dollars, within seconds. And it was pretty clear that something along the chain had broke. And almost always when you see this type of price action, it means the leverage is getting hit. There's a reason why most people should never touch leverage when they're trading cryptocurrencies. And this is the reason. It's because you've got these automated liquidation engines that are driving all of these trades. And as soon as one cascades into the other, you start this chain of events. And what was really interesting with that post that came out, and it was by a guy named Elon Trades, was it showed effectively the trail of what happened and how all of this was effectively triggered by a coin called USDE with $60 to $90 million being dumped on Binance and causing the initial liquidation on Binance. But what people were really focusing on was the tie to the larger macro event, which was the tariff announcement from Trump. And it just was, when you see things that seem too orchestrated, there's the old saying, somebody always knows something. What a way to mask this type of an exploit. And it was kind of interesting because Binance had already identified this exploit and they had communicated that there was a patch on the way for it. And so there was only an 8-day window where this all would have been possible. And they managed to do that, Friday afternoon, right after the markets had closed. You immediately get the news of the tariffs hitting, you start getting initial weakness in the market, you start this liquidation cascade, everyone ties it to the news out of the White House, even though that would have been surprising, right? Because this is not our first tariff rodeo. I actually think one of our very first episodes, we were talking about tariffs then, and the markets were getting hit by the tariffs at that time and then bouncing back and recovering much like we saw today. But it was one of these perfectly timed executions to exploit the collateral engine on Binance using that USDE token and causing the forced liquidations, which ultimately I believe amounted to over $19 billion, which is larger than the FTX collapse. It was larger than anything that happened with COVID. It was the largest drawdown or liquidation that you saw within the crypto complex. So it was a really major event. And I think what was ultimately interesting was when you watched it play out, maybe we've just been around this too long, but it didn't really feel like that much. You watched it. It didn't pull Bitcoin under 100, although on some exchanges where it got really thin, I did see that there were some some orders that were filling right around 100. So it drew it pretty low. But Bitcoin overall, people stepped in on the bid. There were buyers on Bitcoin. And you didn't see that with all the other tokens. A lot of the other altcoins that were out there drew down, 70, 90%. You saw some really major wipeouts happen in that side of the house. So, Bitcoin overall showed pretty good resiliency, bouncing back from that very quickly. It did not hold down there very long before it had recovered back to, the 112, 113 range, ultimately getting above 115 here. And it was a good battle test, I will say, for Bitcoin. It kind of shows when everything really starts falling apart around the crypto industry. I think what you saw over the weekend was where that capital rotates to. There's a fleet of safety within that overall industry, and Bitcoin is the most established and the most liquid of all the digital assets that are out there. And when panic and chaos hits and all these other ones, I think what you saw was that capital goes to where it believes it to be safe, which is in Bitcoin. So I thought that was actually a really good highlight for how Bitcoin can withstand what most others cannot.
Yeah, Bitcoin dominance had a huge green candle. All of this happened in like 10 minutes. We were all on the phone watching it together. And I think it dropped down to 100 for just a split second and then went right back up. And we were all trying to put buy orders in personally on trying to buy the dip. And then all of a sudden it was back above 110. And this happened in like 10 minutes. We were all on the phone. It was just a wild experience to watch it all happen in real time on the phone with people.
Yeah. Well, what was to me the most wild thing was someone on the call got a order filled under 105. And the price that I was watching, I was looking at the Bitstamp price, and it was above 110. And so this kind of got into where it became clear that this was a leverage flush more than just a broader market sell-off at the time. We weren't watching all the altcoins at the time. We were just watching Bitcoin. Was the breakdown of price between the different exchanges, which really only happens in very large liquidity-driven leverage flushes. Typically, you'll see very orderly, at least nowadays. In the early days of Bitcoin and crypto, you would see in 2017, as an example, big differences in the price of Bitcoin across different exchanges or altcoins across different exchanges in different countries. And there was a massive business if you could actually arb those price differences, and they would last for a long time. We don't see that in the price of Bitcoin or even most other altcoins even today. And you saw that breakdown even with Bitcoin was pretty surprising to me. So that was indicative of something that was much larger. And I think, there's several reasons why you could say, the altcoins did substantially worse, the flight to safety. But I think another thing that's really interesting there, and I think this will have longer term negative repercussions for altcoins, is that a lot of the market making for altcoins are done by retail traders on decentralized exchanges. And these people might have, they've worked up to have 10 million, 50 million, $100 million of capital, and they're market making, they're doing farming or whatever they're doing on various different decentralized exchanges. And most of those accounts blew up. And I think that with that, the market making function for a lot of altcoins, I think, are severely to permanently damaged, actually. And I think that's going to have a lot of medium to long-term negative repercussions for the liquidity of those different coins. But it also starts to get into why I said last night I'm the most bullish I felt in a couple of years. And that was not a tweet to say, or an X post, I should say. Tweet is out these days, but an X post to say that Bitcoin is going to rip this week, although it might, or next month. But this was a massive, massive leverage flush. And you think about oftentimes when you have a bull market or the beginnings of a bull market that I think we've seen in Bitcoin, obviously equity markets, gold up, that a massive leverage flush where the price of the underlying asset isn't even down 10%, puts a massive bullish tailwinds for the price to go up higher without leverage actually getting out of control, because the leverage was just completely wiped out. And so it doesn't matter if the next move up happens this week, next month, December. This is a long-term leverage flushing event because of the magnitude of it. And I think it clears the ways for substantially higher prices for Bitcoin, where if you would have asked me, do I think that Bitcoin hits 200K in 2025 a week ago, I would have said very unlikely. And at this point, I would say it's more likely than I would have said a week ago, because of the clearing of the overhang to move higher in prices that I think will be fairly long lasting. And I guess the last point here is, I'm obviously, I feel bad for people that got wiped out, for people that take too much risk, put too much leverage on. But I think a big part of this show and this message that we've continually hammered is obviously the zoom out mentality. And then obviously also with regards to how you think about leverage, why there's so much, I would say, underappreciated value in Bitcoin treasury companies that are able to actually put on leverage in a perpetual manner. Because you could take literally Bitcoin to 1 penny, which I wrote a post on as well. And I said, I didn't dunk on altcoins for losing 60% of their value, because I don't think that proves that they have no value. It's many other reasons that they don't have value. It's not the fact that it flushed. Just how if Bitcoin flushed to a penny, I would be on the hurdle rate next week saying, buy the dip, as long as the fundamentals hadn't changed, and they probably wouldn't have changed. It would not change my thesis. And so downward pricing, if fundamentals don't change, whether it's Bitcoin or an equity, should not change your view of the asset. It's actually the fundamental side of the equation. And I think obviously with regards to Bitcoin, the fundamentals remain strong. And if you have your leverage in a perpetual manner, you can ride out any downturn as long as the time is not, a 6, 8, 10-year time frame, right? Like you've actually zoomed out the time frame, which no other leverage allows you to do.
Yeah, the one piece that I think is important for people to understand is that, this was actually driven by a stable coin. And so there's been a lot of discussion about stablecoins, and people go out to these exchanges to try to apply leverage to their trades. And a lot of times they'll use stablecoins as the collateral. And what happened in this instance was there was a weakness where Binance was using their own spot market in order to value the collateral. And so when you have a stable coin that's supposed to be pegged at $1, but then you have this coordinated dumping of that stable coin in the market, it drew down the value of that stable coin temporarily in that spot market to 65 cents, which for anybody that had margin, it compressed your margin requirements. So it put you into these margin calls and it started auto liquidating your positions. So while everyone felt like they were in a safe position because they were holding a coin that was supposed to be stable, because of that exploit, what most other exchanges would do is they're using this kind of group consensus. They call them oracles, where you're out there and you're actually taking pricing from several different spot markets, and then you're aggregating it and you're creating kind of this smooth pricing so that volatility on any one exchange isn't going to cause this problem to yours. But in this instance, Binance was just using their own spot market in order to value this collateral. So it shows you that even when you think you're doing the right thing out there and using stable coins as the basis for the way that you're going to apply leverage, it's not necessarily the case. There's so much happening behind the scenes. These exchanges are incredibly complex. This is emerging technology, and it's being built very quickly and deployed very quickly. And that can often mean that exploits can be missed. Right? Vulnerabilities can be out there. And because these are exchanges where people can make money by finding and exploiting those vulnerabilities, they're going to continue to try. So you just have to know what you're in for if you're willing to go this far out the risk curve. And this is far out on the risk curve, right? This was when you saw a lot of the historic blowups in Bitcoin, a lot of what drove that price action as well was these offshore exchanges that were giving people 50x leverage or 100x leverage, which meant price didn't have to move very much before you'd be in a scenario where you could get liquidated. And if enough people put on really high leverage, all you have to do is weaken it slightly and they just start cascading into each other. So you got to be careful out there. Obviously, if you're buying Bitcoin, the safest thing to do is just buy the asset. Don't use any leverage. Don't apply that type of risk to your own portfolio. And there's a lesson in there, as Matt said, for any of the treasury companies as well, which is the type of leverage you have matters a lot. And a lot of us saw that pretty clearly when Strategy had the secure loan. And at that point in time, all you would see on Twitter in particular was people trying to calculate their liquidation point, and they were just waiting for the time when the markets would try to flush out MSTR's position and liquidate them. That was the conversation that was happening. So luckily, we've been able to learn from that. Even Strategy learned from that. I think there's no scenario where they're taking that same type of a secured loan again, but the type of leverage you select to apply on your balance sheet matters a lot.
Yeah, I think that it's super important when people are thinking about leveraging their own personal Bitcoin stack. If they're looking to take a loan out on it, there are terms on, I think, a majority of those that have liquidation terms. So like if the price of Bitcoin goes down to a certain threshold, your Bitcoin gets sold and it's gone and the loan is closed. And that protects the lender. And so that type of leverage that you take on is incredibly important, and it shines a light on the opportunity here. Like corporations can take more efficient leverage than a person can, just going to take out a loan on their individual Bitcoin. But one thing that I pulled up here, this is the CoinGlass liquidation leverage chart, and I look at this just from time to time because I think it's interesting to watch, because you can kind of see how the market makers move with leverage. So this is looking at Binance leverage over the last 6 months, and you could see this big wick down over here on the right hand side. This is the event that happened on Friday, where it came and hunted out all of this leverage down to the bottom, basically down to where there was no leverage in the market on the Binance exchange anymore. And then started to work its way back up. So it's fascinating, and you could see the different colors here is the different size of the leverage. So there's at 106,923, there was $571 million of leverage just at that one individual spot. So it's just a fascinating piece to watch, and you could kind of see how the market moves relative to leverage at different time horizons. You could come up here and change the different place. But the other thing that, Matt, I think you hit on, which is really interesting, is this concept of liquidity too. And I've been thinking about liquidity just a lot, and liquidity risk, and how this plays into just global macro markets and how it's evolving and changing. And the unique thing here is, you think about like a publicly traded equity, it's marked to market every day, every trading day, like during the day. It's all what you could go see what it's worth every day. And whereas you look at more opaque markets like private equity might actually be significantly more volatile than public equity markets, because they're just not marked to market every day. You just don't know. You don't see what the value of those specific things are every day. And there are situations where valuation of the fundamentals of the company or the commodity may be just going up and to the right, but you've got the value that's kind of bouncing up and down and around because it is marked to market 24/7. And with equities, they're mark to market all day during trading days, 5 days a week. So it's interesting to think about that construct moving forward. Like liquidity risk and liquidity really matters. And you think about a more dynamic digital world, like everything is getting more and more liquid, and this is the way the world's economy is going. So it was a fascinating event to be a part of, and it's exciting to have that now behind us. And we're still at 115K, right? Like leverage has been wiped clean. As you say, the altcoin markets are completely, they're different now. Like we're at a new point in time. All that leverage being removed from all these other altcoins. There's a different amount of focus on Bitcoin and Bitcoin moving forward. So exciting.
Yeah, it is exciting times, and definitely not boring times. And I guess the last thing, just from kind of conversations that I don't think we've hit on yet, was we've heard some, comments about market makers still making pretty wide markets in Bitcoin and in other other, another, obviously altcoins. And so that kind of leans itself to that this is still working itself through a little bit, even though a lot of the leverage has been flushed, that we're not seeing the type of markets that we've normally seen, which means there's a higher potential for volatility in both directions. And that's not to say that we make new lows or anything like that, just to say that, things might be a little bit more volatile before it clears up, as market makers kind of lick some of the wounds that they got over the last few days.
What is interesting is that the altcoin markets are largely recovering, which I find kind of fascinating with the speed, because Bitcoin dominance is basically exactly where it was before the event again. So it had that immediate spike while everything was going on, but since that time, it's kind of reset. So, but to your point, Matt, these events tend to have market makers very spooked, and they're going to be very hesitant to come in and narrow those spreads on these assets and make those markets in a tight manner. So we'll see how long that takes to shake out. There might be more volatility on the way. We'll just have to see.
Yeah, I think it would be pretty clear for the market as a whole that the Max Payne trade would be straight up from here. Not to say that happens, but imagine you were in a crypto native person your whole life, an exploit of Binance wipes several of these large accounts up, and then you just rip up. I mean, that would be obviously very painful for them, but that's often the way that things go. So we shall see. Ben, I thought you had a really good post, a long form post. I think we should probably chat on that, and then also want to hit on credit markets, because I know Jeff. So maybe we go long form posts and credit markets.
Sure. Yeah, I had to get back to my roots a little bit. It'd been a very long time. That used to be, if you go back probably a year ago, a little less. I mean, I was putting them out kind of towards the end of last year, but any time that I start exploring a topic, I've found the best use of X to kind of just let your thoughts go and just keep typing, keep feeling those thoughts out and see where it takes you. But in this instance, it was something that I thought was important to get out there, because I think that there's a lot of confusion about what it means to launch a treasury company effectively from zero. And there's been a whole bunch of noise out in the market, because we've seen now so many of these different types of financing transactions, pipe transactions, convertible bond transactions. And I think that the market's gotten caught off guard quite frequently with the way that these tend to play out. And obviously on Friday after the market, the ASST pipe unlocked as well. And so when you look at the volume that traded today, I think on our ticker, it was 130 plus million shares trading hands today. So I wanted to give kind of an overview, but I wanted to start it really from the beginning of Strategy's journey, because what I think is very important is that we're in the phase now where the companies that are launching get to launch with the lessons learned from Strategy and apply the treasury strategy differently than the way Strategy built up their own. And when you look at the path that they took, obviously they began with just deploying their cash. They took on some secured debt, which I mentioned a little while ago. They found the convertible bond market. The convertible bond market was actually very helpful to them in scaling. Quite frankly, I don't think that without that convertible bond market, they would be anywhere near the size that they are today. I think they found a really unique pool of buyers out there, and I think that really enabled them to scale this strategy in a way that otherwise they would have been unable to. But then obviously now you see them pivoting and changing the way that they want to apply the leverage. And now it's clear that they view the most efficient use of leverage as these perpetual preferred equities. But when you look at all these new companies that are coming into the market, mostly what we've been seeing now is companies that are reverse merging into the public markets, meaning you've got an entity, and sometimes it's a shell company that's in the public markets, that's already trading under a ticker in the public markets, and that private company merges into the public markets via that instrument. And along with those transactions, there's usually the capital raising. So you got to imagine, I view these kind of as you're funding a startup before it's even public. So you're taking this private entity that's building out a strategy saying, here's what we want to do once we're a public company that's able to leverage the corporate balance sheet and the ability to securitize around that. Here's the value proposition that we feel we offer into the market. And what these companies do before they're even going through these mergers is they go out and they talk to the investors and they start trying to generate support for that and raise capital that's effectively going to provide them the initial scale to get them off the ground so that they could go into the next phase of this strategy, which is applying that leverage and getting these more creative tools out into the market where they can raise capital and buy Bitcoin and scale up the net asset value on the balance sheet. And what comes with those transactions is a huge amount of nuance. And this is where being willing to go through, filings, as tedious as that can be, is a huge advantage if you're an investor and you're evaluating these companies. And the reason being is because it gives you all the commercial terms that come with these types of transactions. And that means things like, how long do you have from the time the transaction closes and the company gets into the public markets between then and when the shares will be registered to the investors? You know the pricing terms that are associated with all the shares that are coming in. You know any of the additional components, things like warrants, or if you've got convertible bonds, you get the terms with the convertible bonds. All those details are typically shown in those filings. So they're incredibly important filings. And they are long. I understand that, and they're a hard read. But that's where I think, there's been a disconnect. I think there's been just a huge amount of excitement in the Bitcoin treasury space, leading into, I'll say June was kind of when the tide sort of turned and you started seeing this long, prolonged drawdown broadly across the board, right? It kind of started when Metaplanet had their meteoric rise there. And then as that started drawing down, you started to see that bleed over into, you could pick a name. It was all of them. And along that path, you started to see these transactions finalize. And what happens is when these shares get registered, effectively what that means is that those investors that put the capital into the pipe that got these companies off the ground, they now have their shares available to them like you or I would in your own brokerage account if you had bought shares, right? They provided capital. For that capital, they were receiving equity. But in these transactions, there's a delay before they actually get access to those shares. And so when you see things like registration statements hit, what that means is that those investors are now receiving access to those shares. They can now trade those shares in the market. And there was a lot of confusion that started piling up because when you look at those statements, if you've got a shelf offering, and this is basically a prospectus supplement that's getting filed with it, what you see in there is something that's termed seller statement, right? And it basically shows the list of all the investors that are getting their shares registered to them. But what's very confusing about it is in the table, the last column effectively shows how many shares would they hold if all of those shares that were being registered in this filing were sold. So it's not a filing that states these people are intending to sell or that they've given some notice that they're liquidating those positions. That's not what it says. Effectively, you can think of it as they bought the shares. Now they have the shares. Those shares from them can only go one direction. They can only be sellers because now they hold the shares. So that's kind of the nuance.
Like activating. They're like activated.
They're activated shares, yes. They're available to be sold now by the investors.
Yeah.
Which just like if anyone went and bought shares in the market, if you go buy shares of Strategy today or tomorrow, those shares can only go one direction from there. They can only be sold, even if you are never going to sell them in the future. The nuance here is these are new shares to the market, but it's the same concept is that talk to 10 different investors that bought, whether they buy in the open market or through a pipe, and you're going to get 10 different answers of the holding period, how they might think of selling shares, but there's no information on if someone even wants to sell the shares or if they're going to diamond hand them till the day they die.
Yeah, and that's one of those important nuances is even with all these institutional investors, when you're going through these transactions, I think that there's this thought out there that as a company, you know exactly who's going to sell shares when the pipe unlocks. And the reality is you have no idea. They get their shares just like anybody else. And as soon as they get them, they're free to hold on to them and take the ride, or they can sell them. And a lot of the people that'll participate in these types of transactions, they'd be classified as fast money. A lot of this money rotates through. There's a lot of transactions that happen in a year, and the capital will roll from one transaction to the other. And sometimes that can give them incentive to go and sell those shares. But the other reality out there with a lot of the pipes in this space is that, the pipe investors have not been on the winning end of this. There's been a lot of pipes that haven't performed. And so when you see the pricing of the pipe and then you see where they immediately trade down to, you can start to get a sense for how these are performing. And earlier in the year, when there was a lot of excitement, you saw a couple that were wildly successful. And that started bringing a lot of capital availability into this, pipe market, which for people that don't know, pipe just stands for private investment in a public equity. And so there was a lot of excitement because those deals were really performing. And then as things cooled down over the summer, there's that delay from when you get that subscription agreement and everyone's agreeing to participate in this pipe to the time that those shares actually make it to the investor. And so some of the risk that they're taking is that in the meantime, you can have market shifts. The market can move against you. You can have sentiment shifts. And you can also have prior deals that don't perform. And if a prior deal doesn't perform, if you put yourself in the seat of a pipe investor, one of the things you might consider is, if I've got any gain on these shares whatsoever, I'm going to try to get some of it. And that can create that kind of a rush to the door effect if you get multiple people with the same idea that are trying to sell at the same time. And so you've seen that across multiple pipes now where there's that kind of immediate activity that happens. But at the end of these transactions, what you get is a company that's in a very strong position with a very strong balance sheet. You get a shareholder base where the cost basis is largely turned over to a lower cost basis. So when you see a significant amount of shares trading at below what the pricing was for the pipe in any of these transactions, what's happening is as more of those shares are trading hands, the people purchasing those shares are achieving a lower cost basis, which removes more of the incentive to sell those shares, right? You're more willing to hold on to those for the long term. And the company now moves into the next phase, which is building towards the future. But one thing that I don't think a lot of people were aware of is what really happens when these deals are being negotiated. And there's a lot of nuance that goes into that, but it's good for the market to understand how pipe investors think about valuing these deals, right? It's easy to look and think that, well, you're just going to go raise money at this massive premium to the market. The reality of these private financings is it's very difficult to raise money at a premium in the market, particularly when you realize that the company that they're investing in isn't even in the public markets yet. So they're making a commitment before you even have any actual trading activity from this company being in the market. And because of that, the investors are typically, very risk averse in the way that they're putting this in. They want to make sure that they minimize the downside risk in this investment. And that was why I highlighted that, most of the conversations that I've heard and the deals that I've seen structured, they're really targeting like a 0.9 to a 1.1. If the market's very favorable, you might be able to get that slight premium, the 1.1 times NAV on a pro forma basis to what the balance sheet's going to hold. And if they're not quite as confident, you might get a 0.9, but it's a very tight band effectively around how that company is going to emerge into the public markets and what their financial picture is going to be. And so that gives some insight into why the pricing of the deals matters, right? It tells you how they were viewing this deal. So anytime that a company is able to raise at a large premium, that's a really good sign that, those investors were seeing a lot of opportunity in that particular transaction. So, these are obviously, very complex, technical events that happen. And we've now seen several of them happen in the space. And quite frankly, the market, I think, is largely going to be closed for a lot of the capital raising activities out of these channels right now because, one, there's weakness in the market, but two, because you've seen several pipe transactions that haven't performed in the way that they were in the earlier part of the year when we were getting more into the mania and the excitement phase that was going on then. So anyways, I'll pause there for a minute, but I just thought it was a good exploration activity to kind of walk through, what these transactions really look like behind the scenes and how to put yourself in the shoes of the pipe investors and view these from their perspective and what risk they're taking and how they might view it when they get access to those shares. And there was this, big push that was happening out there saying, well, just go get investors that are fully aligned long-term for the mission. And what I'd say to that is that's very hard to identify, because you never know for sure what people are planning to do with an investment. And so as a management team, the role is continue to tell your story to these investors, be in contact with them throughout the process. You talk to these pipe investors quite regularly, highlight the road that you're going down and why you think this is going to drive value to their ultimate investment. And out of that, you will get a big portion of these investors that are aligned for the long term, that are taking this ride. But at the end of the day, you never truly know. Once people have their shares, it's completely up to them. They have that right. They took the risk. And at that point, it is fully up to them what they decide to do with that investment.
Yeah, there's a couple of things that I want to add to that. Is there's a general thought that this is like meme coinery, like shit coinery, happening in the U.S. public markets, but we comply with the SEC. Right. Just this last Friday, we filed our Form S-4 on the Semler transaction. That's a 100+ page SEC filing. This is, and as a publicly traded company, we have now been a publicly traded company for 20 trading days. So we are very early in our timing to be able to operate as a publicly traded company. I mean, prior to that, we were a private company that merged with an already public company. So there's a lot of work that goes into this. There's a lot of stuff that's being done behind the scenes that we communicate as much as we can, and I think we've been pretty transparent with our intentions for what's on the horizon. But we effectively just got the keys.
Get the keys. Now the ambition is to get the pref, and let's go. I think I agree with everything that you said, Ben, and also the nice essay that you wrote. I thought it was extremely well written, and I think a couple broader market reactions beyond our company is that I think is probably not fully appreciated yet. Is I do think that the capital markets are largely closed to new Bitcoin treasury companies to raise a large amount of capital, unless you see something, I would say, very large in the differentiation. And I think that's an interesting reflection as you're looking at some of the newer players that are sitting around NAV, some below NAV, some slightly above NAV, but basically valuations compressing to around NAV, that the competition is not going to be as fierce as what you saw earlier this year, probably for quite a while. And so the companies that got through the door, even that have had their valuations reset, that from a investor perspective, kind of looking at this now, looking across the ecosystem, if you find a good management team with a good execution, with valuations reset and less competition to come, that's the type of opportunity where you want to buy. And I think this kind of gets into investor mindset of, you want to buy typically, like if you're trying to allocate to long-term positions when others are fearful. So if you looked at like May, there was a ton of euphoria in the market. Every single deal that was getting announced could get upsized, could raise several $100 million. Valuations, were what they were. I think we could all argue that they, maybe aren't frothy when you think about what they could develop, but they clearly were frothy, at least at the time, versus where they are now. Now you have companies that are trading around NAV with very little competition, probably for years to come, able to put on, amplified Bitcoin exposure. That's the time. That's the time I think you want to be greedy and greedy in the ecosystem and kind of looking for opportunities. And I say that for Bitcoin treasury companies and that space, also for Bitcoin after a massive leverage flush. That when you see fear, which I think you're seeing a lot of place right now, people capitulating, that's the blood you want to buy. And I think that's the place we are in the market right now. And I think it takes that level-headedness, takes that longer-term perspective. And I think it, for the newer companies and just because of the novelty of this space, the ability to at least put in a filing into ChatGPT and say, hey, give me the 30-second summary of what this means if you can't read it yourself, because these things do have material information. And I think when you see them, you can get a sense for where money is pricing a deal. And oftentimes when you're looking at some of these newer companies, it's where like legitimately like 90 to 99% of the capital is pricing the deal. And if 90 to 99% of the capital is pricing a deal at a certain level, you should know that. And you should think about that. That doesn't mean that it has to go to that valuation. Obviously, they're pricing it, hoping they make money off of that price. But to your point, Ben, a lot of them obviously have not worked out, which has now, I think, created some, closing of capital markets for a little bit of time to come. And I think that's probably a good segue into private credit and private credit markets and what we're seeing there, which is also some closing off, at least in the short term over the weekend.
Yeah, but before you jump into that, Jeff, I think there's one more component to this, and that's, one of the markets that consistently does stay open is the convertible bond markets. And you saw several converts in several of the deals for the companies that were just getting off the ground. But what you see there in that market, the reason why those markets stay so open is because largely they can dictate the terms based on what's happening in the market. So you saw a lot of secured convertible debt being added on top of these pipe deals. The problem with some of the convertible debt, and you've seen, some leaders of some other companies that were talking about some of this, is they can put really restrictive covenants on you. As a part of that, they're protecting their position. They're making sure that they're over collateralized on a big way. They can put clamps down on how you can participate in the capital markets, whether you can use an ATM, can't use an ATM. And so I think that was interesting that people started to see the restrictive side of it, because we typically saw what Strategy was getting, which was very favorable terms to Strategy, premiums and 0% coupons and all these things. But the other thing that I think it really highlighted in that market in particular is that there is a difference between companies that take convertible debt when they already have scale and liquidity in the common equity. For companies that are just emerging, that are not very liquid, if you've got a counterparty that is trying to delta hedge against your common equity, that can put significant selling pressure in, particularly if the convertible bond was a significant portion of your capital raise and they're trying to hedge a serious position. And if you don't have the liquidity under that equity, it can have a really serious impact. And so what we used to see with Strategy was that you would see the downward pressure really only during like the 3-hour or 4-hour pricing window, when these people that were buying the bonds were putting on their hedges to get themselves delta neutral by the time the pricing was finished. And so like half the shares would get shorted during this really compressed time period. But Strategy had been trading for, decades. They had liquidity in the equity already. And so the equity was able to absorb that without any real major movements. It would always move, but it wasn't the major movements that I think that you're seeing, and kind of that wet blanket effect that you're seeing on some of these equities right now. As one, they're trying to find shares. It's hard to even find the shares to be able to put on that hedge. But two, just because of the portion of that they make up, it can have a really drastic impact. Now, what you do need to realize is eventually those hedges will be in place. And when they're in place, they just start to act as a normal market participant. So there'll be buyers at certain levels and there'll be sellers at certain levels. But it's that initial hedge to get delta neutral, that's the big one that really can have that adverse impact. So I just thought it was important to gloss over that.
As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private.
Now we'll go over to Jeff for private credit.
Yes. I've been pulling on this string for a couple of weeks now in light of the First Brands bankruptcy announcement that happened a couple of weeks ago, and trying to think through like the implications of the broader market. So Matt, this is a little bit of me sharing my research, and two, trying to get your opinion on some of this stuff. So I would love your perspective, and I'm going to share kind of what I've got so far. So thinking about, you've got public equity market, private equity market. You've also got public credit market, in the private credit market. Liquidity in the private markets is significantly less than the public markets, but there can be better terms in the private market because of the liquidity and the lack of trading that happens in that market. And there are unique opportunities to get alpha or additional yield in the private credit market, and that market has been expanding pretty significantly over the last 5 to 10 years. So a couple of things that I found really interesting thinking about private credit. A lot of commercial real estate also falls into the private credit market. So thinking about like where we are in the status of the world and commercial real estate as an asset, with COVID and a lot of people not going back into the office and these companies moving to like these hybrid workforces, it's put a lot of stress and pressure on commercial leases. Most commercial leases last like 3 to 7 years, with the average being around 5 years. So here we are in 2025. A lot of these leases are rolling over and having to be refinanced, and deals are having to get done and pushed out to, get through the situation that they're in, given that they may not be getting as much revenue as they historically thought. So we've got one thing happening there. Commercial real estate is part of the private credit market. Additionally, you've got a lot of opacity in some of the private credit market. I'm going to share my screen because I think this is just so fascinating to look at. This is the org chart and the capital structure for First Brands, which is like an auto parts company. I think they had around $11 billion of debt outstanding. It's an opaque number. Yeah, you got to look into some of the lawsuits. But one thing that's fascinating here is you look at just this picture and you try to wrap your head around this. If you're like an underwriter trying to underwrite the credit quality of this company, you have to go figure the business structure out. And like, how does the business work? And then somebody hands you this document of this org chart and you look at it and you're like, okay, I've got to understand how each piece of this works in order to understand like where can this potentially go wrong. And I think looking at this is super helpful because you can start to look at how some of this capital moves and is intertwined with these different little special purpose vehicles that are running different business operations. And to me, this just looks pretty sketchy just to begin with. As an alternative, looking at the digital credit market, which is a publicly traded credit product, and what strategy is provided to the market is so clean. You know exactly where you sit. You know every instrument in the market. You know who's senior to you. You know who's junior to you. You know how much your capital that's sitting behind it is worth at any given time. And you have an understanding of like the credit quality and the risk associated with that instrument all the time. And that instrument is relatively liquid. And what happened here with First Brands, which is really interesting, is some of this collateral that sat behind this specific risk. That you can see this email here from the lawyer, is about $2 billion that has effectively vanished in this transaction somewhere. So you've got somebody that was sitting on a piece of private credit that was a function of the credit quality of this company, the cash flow, and the collateral that sat behind it. And now you're getting a response from bankruptcy lawyers that $2 billion has vanished. So the value of that private credit instrument it goes to zero, right? Like it's illiquid. Nobody's buying that from you. It's just a steaming pile of trash that nobody wants to take that risk because I don't know what that risk is. So, maybe they got 9 or 10% return on this private credit instrument because it was opaque. However, significant volatility and uncertainty in what the value of that instrument was at any given time. Now, this on its own isn't like companies go bankrupt all the time. Where this starts to get really interesting is who held the instrument on the other side of the trade. And was that instrument being rehypothecated in different places? Was that instrument being used as collateral in different locations? How was that instrument intertwined with the broader capital markets? And this is fascinating for me because I actually followed and was very close to one of the biggest collateral frauds in the reinsurance market. It like ruined my life for like, I don't know, 6 months because I had to go like fix a bunch of problems in the market. Effectively, there was this company called Vestu. They had $4 billion of fraudulent credit collateralized by a Chinese bank in the reinsurance market. And they tried to call the collateral, and it turns out the collateral didn't exist. So when the collateral didn't exist, we had to go find and replace the collateral while there are like literal hurricanes in the water threatening portfolios. So the problem here may be is if you expect to have this $2 billion sitting somewhere as collateral, that may vanish, that may be gone. And so like how does that impact everything else? Like, is there contagion in other places? And that's what I'm trying to pull on and figure out if there's broader implications here aside from just this one individual, like somewhat large bankruptcy. So Matt, I'd be curious to get your perspective on like broader private credit market, your background of how you interfaced with these trades, particularly at CalPERS, would be pretty interesting.
Yeah, I guess at the contagion level at this point, I'm not aware of massive risk of contagion, but I can tell you how I've seen, and obviously your point on digital credit versus private credit is extremely well taken, where to understand a lot of private credit, you need teams of mathematics, PhDs, and lawyers, structuring lawyers to even understand what the heck's going on. And your chart there showed a clear example of that. That this is not an easy situation to just look at and unpack. You need true expertise to even understand where things were going, even if there was no fraud at all. Which obviously the email reply from the guy named Sonny is not what you want to see, to say the least. But this kind of gets into what is a very common institutional trade, and it's a trade that CalPERS puts on as well, which is a financing carry trade. And Bitcoin treasury companies put financing carry trades on. There's nothing wrong with a financing carry trade. The question becomes, what is your cost of financing? What are you putting it in? What is the ARB, and what is the ability for that financing trade to be called, right? And so in institutional circles, what you'll see oftentimes is financing a derivatives position. So instead of owning the actual, as an example, S&P 500, maybe you buy S&P 500 futures, where you only have to collateralize a little bit of that with cash. And so then let's say you buy a $100 million position of S&P 500 futures, you might be sitting there with $95 or $98 million of cash still in your account, even though you have that exposure because it's in futures, and you obviously have to maintain the collateral, but then you can do whatever you want with that cash that's in your account as long as you're able to meet any margin requirements, right? Which we'll come back to margin in a second. But what you'll see with a lot of institutions is they'll take that cash, and instead of investing it in a money market account, or in institutions, they'll call it a STIF account, a short-term investment fund, they might go put it in something that they deem to be AAA, but not liquid, take liquidity risk. And then they'll just take the position that we are going to buy, as an example, AAA CLOs, which is often what CalPERS might do, right? Where it's deemed to be AAA risk. You have a whole team of people underwriting that risk. You buy an illiquid position that's not marked very regularly or very accurately, and then you just finance it with S&P 500 futures, or mortgage-backed security TBAs instead of mortgage-backed security bonds, or treasury futures instead of treasuries, or repo. You could look at all sorts of different ways to get the financing position on, but then your underlying asset might earn, as an example, SOFR or treasuries plus 150 basis points. And so you're basically creating a situation where if the carry trade, quote unquote, worked, and you hold to maturity, and at the end of maturity, the bonds don't go bankrupt, you've collected 150 basis points of, quote unquote, alpha through this carry trade, right? Where you earn more than the cost of your financing in the investment. So different versions of that are put on at pensions, at hedge funds, and at Bitcoin treasury companies. The interesting part is that at pensions, the trade that I mentioned, there is margin. Like you actually have to post and maintain margin of your positions. And so how that's typically managed is by sizing, right? Where they're not putting their whole portfolio in this trade. They're putting a portion of this portfolio in the trade. Just like how, people that might, individual retail investors that own Bitcoin, they might, invest, put their Bitcoin at someone and take a 50 LTV loan. I don't personally love these trades. To be honest, I help to implement them. And if you're going to help implement them, you do them in your best way. But I don't like trades where you have to post and repost margin. And I think this is what, and I think it's important. I know we hammer this a bunch, but when you think about the Bitcoin treasury companies and the perpetual preferred equity, it's the same carry trade, but with no margin and no maturity. And obviously you're still underwriting the fact that you need Bitcoin to go up over the long run. But you don't even see that at pensions that have long-term capital, the ability to put on non-margin forms of carry trade. And I think that aha moment, people are still grasping. But when it comes back to the private credit market, I think, you saw one of them, blow up. I think you might see, there's always risk of a couple more when things like this happen. Obviously, there's definitely stress in office buildings and, hitting around COVID and the 5-year maturities. And I'm sure there's some that are probably 7-year in some private market CMBS deals. But I think that those types of risks my assumption would be that they're kind of a known mess versus it's always the unknown messes where you start to see pretty large contagion that I think is not underwritten.
Yeah, interesting. Just something to be aware of in digging here. This private credit trends average interest coverage ratio has fallen 52% in the last 3 years, from just a little bit over 3 to now roughly 1.5 in the private credit market. And additionally, payment in kind is up 23% in the last 3 years. So seeing some trends that are going the opposite direction of what you would like to see if you were an underwriter of those particular risks. I think, again, Matt, going back to what you're emphasizing here, this concept of digital credit is so compelling. It's easy to underwrite. The yields are high. They're incredibly stable. I mean, what we've seen so far, right? I think Stretch on Friday, amidst all of the market uncertainty, moved 1%. After hours, it moved 1%. And you're starting to recognize and see stability at different market conditions. And it's a fascinating product if you're an institutional capital manager to add to your portfolio. Like you can go, this weekend I was pounding on Perplexity and just looking at different risks. So, okay, create me an efficient portfolio of STRC and all of these other high yield and real estate ETFs. And the efficient portfolio in that analysis is 100% STRC. It's not even a blend of the other things, because you see the total return and the dividend, the volatility and the yield and all of those things. So yes, the metrics that go into it are a little bit skewed, but it's an interesting way to think through this. Is you got to compare it to all the other stuff in the market, right? The digital credit landscape needs to be compared to the entire world of risk and how much risk per unit of return you take on, not just like comparing it to Bitcoin. Like a lot of people are comparing it to Bitcoin, at least in the Bitcoin space. And it's like, no, you got to zoom out and see the entire world, the entire risk landscape and how it compares. And it's pretty obvious that these things are in a league of their own. Fun times. Digital credit, the real revolution here, the bond market.
That's right. As bad as the wipeout was, the collateral against that margin was there.
The collateral is good. One Bitcoin's one Bitcoin.
Yep. I had to laugh when I was in commercial credit back in my banking days. There's always a couple of stories in every market that really highlight, how you can get caught as a lender. And when you're lending to people, obviously you're underwriting that risk as well. And there was a big one in our area that was called Cybernet. And it was this guy who was effectively running a resale and then a server leasing company. And it ended up becoming like $100 million business at the time, which was, massive for the area. And one day someone went in and discovered that there were actually no servers that they could lease. What they had done is they had put up metal boxes and hardwired blinking lights into them. And then we're going and borrowing from all these banks. And so there were all these banks in the areas that had exposure to this business that turned out to be a total fraud. There was absolutely no collateral value underneath any of this stuff. And you just always end up finding these stories. And it leads you back to why Bitcoin is such good collateral, right? You don't need to trust anything, you know.
Makes you think about some of these 100x PE ratio AI companies that are, getting tons of funding left and right, and how that might pan out. I mean, AI is undeniable. I spent a lot of my weekend on AI, but it's fascinating to see how the money moves at scale.
Absolutely.
Did we blow your mind, Tim?
I'm just I'm trying to take it all in.
Oh God.
That's it, folks.
He's making sure he doesn't have any loans out to anybody.
Yeah, I'm just looking at
what is my margin requirement?
I'm looking at my list over here on the side for that's it for this week. Thanks for listening, watching. For Ben Workman, Jeff Walton, Matt Cole, I'm Tim Kotzman. We'll be back next week with another edition of The Hurdle Rate.